Welcome back to the ProTicker podcast. You're with us for our Monday morning edition covering major financial magazine headlines, everyone. And let me tell you, it has been a wild week in the markets. Ups, downs, surprises left and right. Enough to make your head spin. So we're going to dive into the top financial headlines and really try to pull out the golden nuggets, the stuff you need to know to navigate this volatility.
Yeah, it's been a lot to unpack from the past week for sure.
We've got tariffs really throwing a wrench in the gears of global trade. We've got DoorDash making a big splash in the S&P 500. There's even whispers of a potential flash crash sending shivers down some investor spines. And to top it all off, we're going to take a little trip back in time to the dot-com bubble, see what parallels we can draw with all the AI hype these days. But first, let's kick things off with a look at the global markets. CNBC's Asia Markets Live blog is painting a bit of a mixed picture over in Asia after, well, as I said, a pretty volatile week.
Yeah, and a big part of that mixed bag is all the uncertainty around President Trump's policies on tariffs. Investors are definitely on edge, especially those with a stake in steelmakers. CNBC even mentioned Hyundai Steel saw their shares drop almost 9% today, all in anticipation of those 25% tariffs on steel and aluminum imports that are supposed to hit Wednesday.
It's like a big dark cloud hanging over the entire steel industry. And we're not even factoring in the existing oversupply of Chinese steel that's already out there impacting the market. CNBC's European Markets Live blog is highlighting the ripple effects happening over in Europe, too. Like auto stocks saw a bit of a rally after Trump exempted some automakers from those tariffs. But the general feeling seems to be one of, well, I don't know, cautious optimism. What do you think?
Absolutely. I mean, the whole situation with the U.S., Canada, and Mexico is still very fluid, right? All these sudden policy shifts make it really hard for businesses to plan for the future. It's like, do you invest? Do you hold back? Tough call.
Definitely a tough call. And just to throw a little more fuel on the fire, China announced tariffs on certain Canadian agricultural goods over the weekend. CNBC's Asia Markets Live blog reported a 100% tariff on things like rapeseed oil and a 25% levy on pork and fish.
Oof. Yeah, that's not good.
So it's basically a classic case of you hit me, I hit you,
Yeah.
a tit-for-tat trade war. And those rarely end well for anyone involved. For anyone listening who might not be totally familiar with the term, a trade war is when countries go back and forth slapping tariffs or other trade barriers on each other. Tensions escalate. And ultimately, it just ends up hurting everybody. It's like a dangerous game of economic brinkmanship that can really destabilize things.
Right. It shakes up those global markets. And this all feeds into a bigger conversation about protectionist policies and the potential for some serious economic disruption. The Wall Street Journal had a good piece called Markets Finally Woke Up. It really captures this whole sentiment. The article points out how, at first, investors were focused on the potential benefits of Trump's policies, things like deregulation and tax cuts. But now, they're starting to grapple with the potential downsides. And, of course, a big one is the impact of these tariffs.
The article paints a pretty concerning picture. It says that tariffs are starting to paralyze businesses, creating anxiety among consumers, and basically just injecting this whole sense of uncertainty into the global economy. And, this isn't just about numbers on the spreadsheet, right? This is about real people and businesses feeling the pinch.
Yeah, exactly. It goes beyond just tariffs. There's this broader sense of unease about the future of the U.S. economy.
Right, like where are things headed?
Yeah, and for our listeners, if this trade war keeps heating up, it could impact everything. I mean, everything from the prices you see at the grocery store to the overall health of the economy.
So, bottom line, paying close attention to how all this develops is crucial. Now let's switch gears to a story that's creating some buzz in the tech world. DoorDash joining the S&P 500. MarketWatch had a piece. DoorDash's stock pops. They're set to replace several companies, including some big names like BorgWarner and Teleflex.
That's a huge move. Signals a couple things, I think. First, being in the S&P 500 is like joining this exclusive club. It's for the top 500 publicly traded companies in the U.S. It's like a stamp of approval, a sign that you've made it.
It's like arriving on the scene in style. And what's interesting is that DoorDash wasn't even the biggest company eligible for inclusion. The MarketWatch article points out that the S&P committee seems to have prioritized stability over volatility in this round of selections. They went with DoorDash over maybe larger but less predictable companies like AppLovin and Coinbase.
Interesting. It's a peek into how the committee's thinking. They're essentially saying size isn't everything. They're looking for companies with a solid track record and a sustainable business model.
Makes sense. And of course, this announcement sent DoorDash's stock soaring. Same with the other new companies being added. It's just classic supply and demand, right?
Yeah.
Index funds need to buy up shares of these newly included companies. The demand goes up, so does the price.
Yep. Economics 101 in action. But for you, the listener, we're curious. Are you a DoorDash user? Do you see this S&P inclusion as a good sign for their future? What kind of impact do you think this will have on the gig economy as a whole? We'd love to hear your thoughts.
Yeah, chime in. All right, let's transition now from the excitement of the S&P 500 to something that's been giving some investors the chills.
Yeah.
Flash crashes and, well, the dreaded R word.
Oh, yeah, the economic bogeyman.
Right. So, MarketWatch has an article. One of Wall Street's biggest bulls now says a flash crash can't be ruled out.
Mm-mm.
And even Ed Yardeni, known for his generally pretty optimistic outlook, is waving a caution flag.
That's definitely noteworthy. When someone like Yardeni, who's usually pretty bullish, starts talking about a potential flash crash, it makes you pay attention.
It definitely does. But before we get into the nitty-gritty, maybe we should define what a flash crash is for those who might not be familiar. Basically, it's a super sudden, rapid drop in stock prices, often triggered by a bunch of things happening all at once, like high-frequency trading, algorithmic errors, and good old-fashioned panic selling.
Think of it like a sudden, steep drop on a roller coaster. It's scary. You might feel like you're going to lose your lunch, but it's usually over pretty quickly.
Perfect analogy. And the MarketWatch article actually brings up some pretty eerie parallels to some historical examples, like from 1962 and 1987. It reminds us that these events, while rare, are not unheard of.
Yeah, they can happen, and definitely something to be aware of, especially with all the other anxieties floating around the markets right now.
Yeah, like a perfect storm brewing. And to add to that mix of concerns, we've got the rising odds of a U.S. recession. The MarketWatch article points to a few contributing factors, including, you guessed it, President Trump's tariff policies seems to be a recurring theme today, as well as potential cuts to the federal workforce.
Right, those are definitely two big factors, but it's worth noting that even though Yardeni's raising this red flag about a possible flash crash, he's not completely doom and gloom about the U.S. economy.
No, you're right. The article says he still thinks the stock market could recover in the second half of the year. But he's definitely acknowledging the current volatility and all the uncertainty.
So it's like this mix of potential risks and potential rewards.
A real balancing act. But I'm curious, how are you feeling about all this, the possibility of a flash crash or a recession? Are you taking any steps to prepare, maybe diversifying your portfolio? Hold on to a little extra cash? Let's talk about it. Now let's switch gears again and talk about something that's been generating a lot of buzz. Artificial intelligence. It's everywhere you look these days. And the Wall Street Journal had this really interesting article called What the Dot-Com Bust Can Tell Us. And it offers a fascinating perspective. It draws parallels between all the AI excitement and, get this, the dot-com bubble of the late 90s.
It's a good comparison. Makes you think back to the days of Pets.com and Webvan, companies with huge valuations, and ultimately a painful burst when that bubble finally popped.
Yeah, a lot of people got burned. But here's the key takeaway from the article. Even though a lot of companies crashed and burned during the dot-com bust, that hype about the internet's transformative potential, it turned out to be right.
Right, that's the important part. The article's arguing that we might be seeing a similar thing with AI. Sure, there's a ton of hype, maybe some inflated valuations, but there's also the potential for some groundbreaking advancements that could really change the world.
Absolutely. And the article points out some of the more tangible AI advancements that are already happening. We've got smarter search engines that can basically read our minds, code writing bots that can churn out software like Noti's Business, even AI agents that can handle all these complex tasks, which frees up humans to focus on more creative and strategic stuff. The article even suggests that AI could lead to these massive productivity gains down the road, like revolutionizing whole industries.
It's definitely an exciting time to be watching how AI develops, but just like with the internet, there are going to be winners and losers. Some companies are going to skyrocket, others are going to crash and burn.
And that's why it's so important to be informed and to really understand the forces driving this whole technological revolution.
Absolutely. I mean, just like the dot-com era gave us giants like Amazon and Google, we can expect to see new titans emerge from this AI boom.
For sure. So I got to ask you, the listener, do you see AI as a revolutionary technology like the internet? Do you think it has the potential to be just as transformative? What kind of benefits and risks do you see? Keep the conversation going. Share your thoughts with us on social media. But before we get too lost in the world of AI, let's touch on a few other notable headlines that caught our eye. One interesting development is Japan's push for higher wages. Bloomberg has a piece. Japan's Ishiba urges companies, unions, to achieve strong wages. Prime Minister Ishiba is urging companies and unions to work together to really boost worker pay.
Yeah, that's interesting, especially when you consider Japan's been struggling with deflation and slow economic growth for a while now. Higher wages could help increase consumer spending, maybe even stimulate the economy a bit. Of course, we'll have to see how the whole negotiation between companies and unions plays out.
Right, it's a wait-and-see situation.
Yeah.
Now, on a maybe less positive note, there's some news about Social Security. And it's not exactly good news for beneficiaries.
Unfortunately not. MarketWatch has an article, Social Security to increase overpayment withholdings to 100% from 10%. It says the Social Security Administration is planning to increase the amount they take back from folks who were overpaid benefits, bringing it back up to 100% from the current 10%.
Wow, that's a big jump. That's going to impact a lot of people, especially those who are elderly, disabled, or low income.
It is. And the article brings up some concerns that this policy reversal could end up punishing people who didn't even realize they were being overpaid in the first place. Imagine getting a letter saying you owe the Social Security Administration a bunch of money you might not even have. Tough spot to be in.
Yeah, that's really rough. All right, let's wrap up this first part of our deep dive with some news from the real estate world. Bloomberg reported in an article called Rocket Agrees $1.75 billion deal for real estate broker Redfin that Rocket Companies is buying Redfin. A massive $1.75 billion deal.
That's a big shakeup in the real estate industry. Rocket, known mostly for their mortgage business, is jumping into the real estate brokerage market with this acquisition.
It's a big move. And the article says it's all part of Rocket's plan to use technology, especially AI, to make the whole home buying and selling process easier. It'll be interesting to see how this acquisition changes things in the real estate industry and what it means for buyers and sellers.
It's clear that Rocket is betting big on technology playing a huge role in the future of real estate.
Definitely. All right, we've covered a lot in this first part of our deep dive. From all the anxiety around tariffs and a possible recession to the excitement of DoorDash joining the S&P 500 and the interesting similarities between the dot-com bubble and the current AI frenzy.
And we've only just scratched the surface.
So much more to talk about.
We'll be back after a quick break to go deeper into some of these topics and see how they all connect. Welcome back, everybody. Let's dig a little deeper into some of these topics. Try to connect the dots between what might seem like totally separate things happening. I think it's worth circling back to all that anxiety around a potential recession. We touched on it earlier, but there's a lot to unpack there. And honestly, it's something that's on a lot of investors' minds right now.
No, you're absolutely right. That Wall Street Journal article, Markets Finally Woke Up to Tariff Reality. I think it really captured that shift in investor sentiment. It's like a light bulb went off. And they're finally realizing that, hey, those trade wars could have some very real consequences.
Yeah, exactly. There was so much optimism early on, about the potential benefits of the Trump administration's policies, the tax cuts, deregulation. But now some of that shine's wearing off. And those same investors are starting to see the other side of the coin. The tariffs, the ripple effects.
And it's not just about how investors are feeling, right? Those tariffs are having actual real-world effects. Businesses are putting the brakes on expansion plans. Consumers are getting nervous. There's just a general unease in the air about where the U.S. economy is headed.
Exactly. Uncertainty makes people cautious, and caution can slow things down. And it's not just the tariffs themselves. It's that broader sense of, not knowing what's coming next for the U.S. economy.
And you can see that uncertainty reflected in the markets. We're seeing Treasury yields dropping, a weaker dollar, and stock markets losing those gains they made after the election. That Bloomberg article, Treasuries Gain as Trump Transition Talk Fuels Recession Angst, really hit the nail on the head.
It's a pretty sobering picture, for sure. All that Trump transition talk is making waves, shaking confidence, and adding fuel to those recession fears.
It's interesting, though, because even with all this doom and gloom, there are still some optimistic voices out there. We talked about Ed Yardeni earlier.
Ah, yes, our resident optimist.
Even though he's raising concerns about a potential flash crash, he's not totally pessimistic about the future.
Right. Like that MarketWatch article pointed out, one of Wall Street's biggest bulls now says a flash crash can't be ruled out. Yardeni still thinks the market could bounce back later this year.
So it's not a guarantee that we're heading into a recession.
Not necessarily, but it's a possibility that investors need to be ready for. It's like driving in fog. You got to slow down, be extra careful, and be prepared for anything.
So maybe a time for cautious optimism.
Yeah.
Not ignoring the potential risks, but also not hitting the panic button and making rash decisions.
Exactly. Smart investors make smart decisions, and that's what we're trying to do here. Give our listeners the info they need to navigate these uncertain times.
Speaking of navigating uncertainty, let's bring back that Wall Street Journal comparison of the AI boom to the dot-com bubble. It's such an interesting analogy. And it's not just about the surface-level similarities with all the hype and crazy valuations. It's about the potential for long-term transformation.
And it's about understanding how innovation works in cycles. The dot-com bust was painful for a lot of people, but in the end, it cleared the way for the internet revolution we have today. In the same way, this AI boom, even if there's a correction or things slow down, it could still completely reshape the world.
The Wall Street Journal article really emphasized that point. It talked about how AI could change how we work, live, interact with everything. And it's not just some sci-fi fantasy. We're already seeing real signs of AI's potential right now.
Absolutely. Smarter search engines, bots that can write code, AI agents handling complicated tasks is like the early chapters of what could be a truly revolutionary change in technology.
The article even talked about AI driving huge increases in productivity down the road,
Right.
like changing entire industries. Imagine AI taking care of all those boring, repetitive tasks, freeing up humans to focus on more creative and strategic things. It's mind-blowing.
It really is. And just like with the internet, some will win and some will lose in this AI revolution. Some companies will become giants, others will just disappear. That's why it's so important for investors to understand what's driving this whole transformation.
The Wall Street Journal article also had this fascinating section on how all this AI investment is driving up the demand for NVIDIA's GPUs. They're essential for all that heavy-duty computing power needed for developing and using AI.
Yeah, NVIDIA is a major player in this AI game. And their market cap just keeps going up, which shows their vision and how they can adapt to the changing tech landscape. It's amazing to think that a company known for graphics cards is now leading the way in one of the most transformative technologies we've seen.
It really shows that we're still in the early days of the AI revolution. There's so much more to come. It's exciting and a little bit scary all at the same time.
Speaking of exciting and scary, that MarketWatch article, is the chip sector having a meltdown? By this measure, it's mostly just NVIDIA. It offers a different take on how chip stocks have been performing lately.
Oh yeah, there's been a lot of talk about a possible chip sector meltdown, especially after all that DeepSeek stuff happened recently, which really shook things up. But the MarketWatch article suggests it might not be as bad as some people are saying.
Right. While NVIDIA's stock has taken a hit, and companies like Broadcom and Marvell have also gone down, the overall impact on the chip sector's market cap isn't as huge as some people might think.
And they say that's because NVIDIA, even with the recent dip, is still a massive company with a massive market cap. It's still worth trillions of dollars, which dwarfs Broadcom and Marvell.
So it's more of an NVIDIA-specific correction, not a total chip sector collapse, as the article puts it. And it's a good reminder that even when things are shaky in a particular sector, there are still opportunities out there. Smart investors know how to spot those opportunities and make the most of them.
So even with all the volatility and talk of recessions and trade wars, there's still reasons to be optimistic. It's all about perspective and understanding what's really going on.
Absolutely. And speaking of what's going on, let's not forget about the human element. That MarketWatch article, stock market uncertainty can trigger panic selling. Here's a better option. It has some really good advice on how investors can manage their emotions when the markets are going crazy.
It's easy to freak out and get caught up in the fear when the market's all over the place. But like the article says, staying calm, being rational, and sticking to your long-term investment plan is key.
It's all about focusing on what you can actually control, not letting the things you can't control eat you up. Easier said than done, of course, but it's so important for making good investment decisions.
Now, going back to those steel makers who are getting hit hard by the new tariffs, the CNBC Asia Markets Live article talked about how Hyundai Steel is taking a real beating. Their shares are down a lot.
It's a tough spot for steel companies. They're stuck in the middle of this trade war, and the tariffs are just adding to the problems they already have, like the oversupply of Chinese steel.
It really shows how those trade wars have real consequences. They impact businesses, workers, and entire industries. But even with those challenges, there are companies out there adapting and finding ways to succeed.
Like DoorDash. They're getting into the S&P 500, growing their business, and using technology to stay ahead of the game.
It reminds us that even when things are uncertain, some companies find ways to grow and do well. Now, before we move on to our final thoughts, there's something that struck me when we were talking about AI. The article mentioned those AI agents that can handle all those complicated tasks, but it got me thinking about the ethical side of all this. As AI gets more and more advanced, are we opening up a Pandora's box? Who's to blame when an AI makes a mistake, especially if that mistake has real consequences in the real world?
That's a great point, and it's a conversation that's just starting. As AI becomes more a part of our lives, we have to think seriously about the ethical side of things, the potential biases, the safeguards we need to put in place. It's our responsibility to do that. It's like teaching a child right from wrong. We need to guide how AI develops so it's used for good, not for harm.
Absolutely. It's complicated, no easy answers. But it's a conversation we need to have. We've covered a lot of ground today. From trade wars and all the recession talk to the rise of AI and what's happening in the real estate market, it's a lot to take in. But hopefully you're feeling a bit more in the know and ready to deal with these crazy times.
Yeah, that's the goal, to empower, not overwhelm.
For sure. So before we wrap up, let's do a quick recap of the main points. We started by looking at those choppy global markets. We talked about how President Trump's tariffs are creating all this uncertainty and volatility all over the world.
And how those tariffs, along with other things, are fueling those anxieties about a possible recession in the U.S.
Then we switched over to the tech world. We looked at DoorDash, making that surprise move into the S&P 500 and what that means for the growing influence of tech and the gig economy.
Right, and we took that interesting trip back in time to the dot-com bubble to see how it compares to all the hype around AI today.
It reminds us that hype and speculation are always going to be part of how new things develop. But in the end, it's about finding those companies and technologies that can actually change the world.
And that brings us back to the big theme of today's deep dive, dealing with uncertainty.
Yeah, whether it's the uncertainty around trade wars, the possibility of a recession, or all the crazy advancements in AI, we're living in a time of constant change and disruption. So what can our listeners do to stay ahead of the game?
I think the most important thing is to stay informed. Don't bury your head in the sand. Keep up with what's going on in the markets and the world. Read articles, listen to podcasts like this one, talk to experts. Don't be afraid to ask questions.
Knowledge is power, right?
Absolutely. And the second thing, don't let fear stop you from acting. It's easy to get caught up in all the negativity, but remember, every challenge has an opportunity hidden inside it.
So look for those opportunities. Be flexible, be creative, and be open to change.
And finally, remember, you don't have to do this alone. Find a good team of advisors you trust. Could be a financial planner, a mentor, or even a group of people who think like you and can offer support and guidance.
Working together and sharing knowledge can be so powerful, especially when things are uncertain.
So as we wrap up today, I'd like to leave you with something to think about. Given everything we've talked about today, those economic headwinds, the new technologies, how investors are feeling, what can you do today to handle all this uncertainty and maybe even find some new opportunities?
What little things can you change? What knowledge can you seek out? What actions can you take to not only survive the tough times, but come out stronger and more resilient on the other side?
It's a good question to think about. And we'd love to hear your thoughts. We're all in this together. And by sharing what we know and how we see things, we can help each other figure out this complex financial world.
And on that note, we'll see you all tomorrow morning with more headlines from those big financial magazines. Thanks for joining us on this deep dive.